Hi, timing is everything. 1 minute past 11 o'clock set off time, and here we go with today's live webinar where we're discussing about timing is everything for expats with dividend, savings and capital gains, as well as income, living and working abroad. There's quite a broad issue that we want to look at, and we'll do a deep dive into that today to try and understand what the advantages are of being able to have a situation where you can use the timing of the tax year to your advantage to maximise your savings. Now, we all know that if we're operating as a contractor, or if we're operating as a business in the UK, the timing of what you do in terms of paying dividends, paying income, paying bonuses, can have a material impact on the amount of income that you and tax that you pay. So there's been a lot of changes in IR35 in the last few years in the UK. We're not here to discuss that at this event. What we are looking at is just the general timing thing. So we're assuming that you could use your own company either as a personal service company for IT, for contracting, or as it's your own business, and you can time dividends and interest and other payments to yourself or your family or your employees and for expats. So first of all, let's look at dividends. In the UK, dividend tax is slightly lower. Now, it's going up from April 22. So it's been 7.5% at a basic rate, going up to 32.5% a higher rate. Now, it's going up by 1.5%, 1.25% this year at all the different rate bands. So we've got a personal allowance of 12,570. I'm going to use 12.5 as a round figure for this talk rather than to overcomplicate the numbers. So it's about 12.5 for the personal allowance, no tax, and it's 20% up to 50,000, and then it's 40% up to 150,000, and over that it's 45%. So when you're paying dividends, you've got an additional allowance of 2,000 in addition to the 12.5, and then you're paying 7.5% if you're a basic rate taxpayer, or it rises at the different levels to the new rate of 33.5 or 39.35 if you're on the additional rate. So that the rate that you're paying depends upon your basic rate tax for those dividends. So if you're but the thing about dividends is that it's movable income. So it's not income that is designed for and fixed to where it's paid. So if you're carrying out the economic activity in the UK and you're a tax resident in the UK and you pay the dividend in the UK, it's taxable in the UK. But if you're an expat living and working abroad, the dividend is taxed in the jurisdiction in which you are tax resident. So if you're not doing the work from the country where the company is paying the dividend from, then that dividend becomes movable income. So it becomes taxable in your country of location. So you've got a tax status which only taxes worldwide income, local income, and not worldwide income. You've got a tax status where there's a zero rate on dividend income as a movable income. The expat can pay less tax, so you could pay 0%. So a Cyprus tax resident expat, whether they're living in Cyprus permanently and working from Cyprus, or whether they're a nomad based in Cyprus, any dividends they receive from an overseas company is taxed in Cyprus at 0%. So a non-dom expat pays 0% tax on dividends, and that's unlimited. So an expat from a UK company could earn 100,000 in dividends while a tax resident in Cyprus or another jurisdiction and not pay any dividend tax in the UK because their work is done abroad. It's paid to the tax beneficiary who's legally tax resident in another jurisdiction. Okay. Now, the thing about the timing there is that you have to be tax resident before that dividend is paid. And you have to pay the dividend within a tax year. So there are issues there for consideration. So if you've got income and you're paying dividends and you're going expat, then you need to have your tax resident established, your residency permits, your visas, your tax resident established and in place before you pay that dividend. And that obviously is then constrained by the tax year end. So if you can have a retained profit and you're not forced to distribute the profit, then you could hold on that dividend and until you have the tax status sufficient to receive that dividend without zero tax. Now, thinking that through, if you're an expat that's tax resident and has some dividend tax liability abroad, then you might consider it slightly differently as well. So if you're in a calendar tax year and you pay the dividend in let's say January, February, March in the first quarter, then that could be paid out and it's taxed in that current year. But it could still be a tax deductible, a dividend that's recorded in the UK accounts of that company before the end of the current tax year. So it gives you an option to make payments out as dividends before the end of that tax year. With split years, you've then got other options as well, but we're going to look at the timing with regard to split year at next Wednesday's live webinar. Just think that one through. As long as your company year end allows, and you can make that dividend distribution payable within the calendar year, then it's taxed in that calendar year. So with the expat and the tax resident abroad, even if the dividend is deferred, you might relocate in the middle of the tax year. As long as the dividend is deferred and paid after the tax registration and before the end of the tax year, it could be counted as tax for the overseas period of tax resident. And in Cyprus, that is zero for expats. In other jurisdictions, there might be no local tax on that, or there might be a reduced rate, depending upon what your liability is in the UK. If you're going expat in the current year, then obviously you could pay your 2,000 without getting taxed in the UK, for example. So if you've got a property rental company in the UK and you're a tax resident in the UK, you could use your allowance before going expat to take that extra 2,000 tax-free. And as a way of getting additional benefits and with a lower tax rate. So that's another consideration to bear in mind there. So with dividend taxes going up, expats of relocating from the UK can enjoy lower rates of dividend tax going forward for their contracting company or their nomad business. And if you want to know more on that timing issue and getting that relocation done, contact us at productpartnership.com. This goes as well, though, for investors. So if you've got an investment portfolio that's paying dividends, those dividend timings are also applied. So if you relocate abroad to live off dividends from an investment plan, those dividends, again, they're movable income. So as you go expat, if you as long as you've got a tax resident, a legitimate tax resident, before the dividend is paid, that then becomes a tax-free payment to you. Going on to the next stage, we want to look at interest. Interest paid to you on a loan. We're not talking about royalties or other sort of commercial incomes at the moment. That's a separate issue that we can cover in a different event. I'm talking about interest from bank interest, from investment interest, or loan interest you might receive. Again, that's movable income. So it depends upon where you're relocated at the time and where you want the tax deduction to take place. So if your corporation, if your business or your family trust is paying the interest, then the timing can be managed to utilize the two overlaps of a UK and a calendar year tax year end differences. So you can make a payment in the first quarter of the calendar year before the end of the UK tax year on the 5th of April, and then another one can be made at the end of April. Within within 6 months, the two payments could be made, and they can both be allocated to different UK tax years, but one overseas tax year. So if you've got a plan for 2023 to relocate again or return to the UK, then it's possible to bring forward and have a number of different payments of interest in a year to maximise your lower tax income, whether that's zero or whether that's a reduced rate, or whether it's a non-remitted worldwide income tax basis that you might get in somewhere like Portugal. So again, Cyprus for expats has 0% interest. So if you've got a big loan that's paying interest to you, or an investment portfolio, corporate bonds that's paying high interest rate, in Cyprus an expat will pay 0% tax. And the timing, you've got the two tax years and the overlaps. You've got the first quarter, and then the remaining 9 months of the year can allow you to receive two substantial payments in one calendar year as an expat overseas, on a calendar year, a tax year, but it's spread over 2 years in the UK, depending upon your arrangements. So with income, it's slightly different. I mean, most income is going to be taxed at some point somewhere. So in certain jurisdictions, you can earn 0% income tax from your earnings. So again, the advantage there is to use the UK, depending on where the income is paid from. So paying the income from a UK-based business or company, it can be timed in such a way that you could, if you've got the ability to manage it, you can make income payments in the first quarter and the second quarter if you've got a calendar year and a UK tax year entity to maximise your use of allowances. So anybody going new expat or returning to the UK could utilise a personal allowance in the first quarter and the second quarter. So an expat returning to the UK to take on a salary of let's say 6,000 a month, if they return to the UK in February 23, for example, or February 22, and they earn 12,000 between February and the end of March, as long as they can use a split year treatment, that would be the sole income that would be taxable in the UK for that current tax year to April 22 or April 23. And therefore, that's an extra use of the personal allowance by timing the return or the leaving from the UK to be cost effective. Now's the time that I wish I had a glass of water to hand, but I don't. Similarly, when you leave the UK, so if you've got a contract to leave the UK and you don't want to use a split year, there's an advantage for you not using a split year. We'll talk about that more next week. But if you've earned 12,000 from April 22 until the time that you leave the UK, by registering that you've left the UK and earning no more money in the UK before April 23, you'll get any tax back at source that you've got on that, or you'll have no tax liability on that. So if you're self-employed and you leave the UK earning less than the personal allowance, 12,500 and 2,000 in dividends and 1,000 in interest, you will pay in April 23's tax return no tax. So timing is everything when you relocate from and to the UK, either in the first quarter or moving out in the second quarter. That's without the use of the split year. Split year complicates matters, and we're covering that in more detail in next week's webinar. Watch us then, or contact us at proactpartnership.com. You can live chat to us and message us from our website at proactpartnership.com. We've got a retained client service that guides you and advises you throughout the year. Go along to proactpartnership.com, click on live chat, register for our online service, and consider subscribing as a retained client for free reviews, consultations, and advice throughout the year. In the rest of the webinar, we're going to look at capital gains. Just to finish off on income, again, the income that you earn worldwide depends upon the jurisdiction that you're in. So some jurisdictions will have full rates of income tax, some will have flat rates of income tax, some will have personal allowances, some will have zero tax. So again, the timing of that and the organisation of where the income comes from can make a big difference. So if you're in an expat in a jurisdiction where there's high income taxes, by using a personal service company or a contracting company that you control, you can reduce the amount of tax that you pay. And again, organising that and the timing of that is essential, which is very, very true with capital gains. Now, with capital gains, you've got a personal allowance each year as an individual. So if 2 or 3 people own a property, they've each got their own personal allowance. But any capital gain is after the personal allowance is taxable. And for this purpose, there's 2 sides of the coin. All property in the UK is effectively subject to a capital gains assessment, whether it's done through a corporation or as an individual. And again, that's a topic for a different webinar. And that's not really avoidable unless you want to consider being a lower or high rate taxpayer when that capital gains is assessed. What I'm looking at here in this webinar is capital gains that you're making and the timing of those gains on investments or business sales. So you can get entrepreneurs relief when you retire and sell up your business later on. But if you're going public or if you're going to sell the business in any way, then you've got a potential capital gains, but you can still save from that by going expat. So with investments and with share sale, including share sales, and capital gains from crypto sales, if they're held in the UK, then those gains are assessable in the UK. But if the beneficial owner of that gain is a tax resident overseas, an expat, holding UK fixed capital gains on disposal, if they're crypto or investment or business share sales or investment share sales, then that capital gains tax can be deferred up to 5 years and beyond. Now, you used to be able to do this for property, but you can't do that for property anymore. And again, timing is everything on this. you have to, as the Matalan people found in the recent HMRC tax ruling, you have to be expat and tax resident in the year before you make the disposal. So if your company is being listed on the stock exchange, shares are being sold, or there's a private sale, or equity stakes are being sold, or you're selling your crypto, or you're selling your investment, you have to be expat and tax resident expat in the year before you start making the decisions for that disposal. You cannot plan the sale and then go abroad, register as expat, and then receive the money and not pay the tax. It doesn't work like that. So you have to take the decision to go expat. So if you're in the UK today, leave before the end of the tax year on the 5th of April, and then start making your arrangements to dispose of the business or the crypto or the investments. Okay. If your investment advisor, your crypto holding, your shares sailing, your lawyers, your accountants, they're all tax agents, they're all tax registered. If you've got correspondence and evidence that the HMRC could uncover to show that you were planning the disposal, or not that you're thinking about it, that you've got an agreed sale before you go expat, then your gain is potentially taxable in the UK and not avoidable. So that's the important thing. You have to leave the UK first. Leave the UK, then make your actions to sell, whether you're listing the company, private equity sale, or a crypto sale or an investment sale. So that's the first thing. And then once you're abroad, the capital gain is deferred from the UK. So it's still charged in the UK, it's still reportable in the UK, and it's deferred for up to 5 years. So if you stay outside the UK as a tax resident for 5 full tax years, then it becomes tax-free. Now, the important thing there is it's 5 full tax years to make sure that it's capital gains tax-free. It's not 5 calendar years. So you can't, if you leave on the 1st of January 2022 and you can't return 5 years later on the 1st of January 2027, because that's not 5 full tax years. It's actually only 3. So actually the period of risk is actually up to 7 years, depending upon your timing. So you can leave on the 1st of April. You can then have 5 full tax years and return on the 10th of April after 5 full tax years, and that will cover that. But generally, the HMRC look at a 7-year period for the period, 7 calendar year period for the date of going expat to returning to potentially claim something on the capital gains. So timing is everything. When you leave the UK, when you start making the decision to sell, when you receive the funds, because obviously if the sale completes on the 6th of January, there's a whole 364 days before the first full tax year starts. So you have to complete the sale by the 5th of April to then for the next tax year to count as the first full tax year of your exemption. Okay, so the year of sale is 0, and then 5 full tax years as expat for the benefit to be non-resident. If you go shorter, that's okay, but you will get at least 100% of the tax if you've not been out of the UK for more than 3 full tax years, with the potential for them to review it and tax all your worldwide income, gains, dividends, and interest for that. So, you know, this is the interest. 3 full tax years is always a key for any of these expat decisions, but for capital gains, it's 5 full tax years that you need to consider. Is it worthwhile? Is it worthwhile to save the 20% capital gain potential on crypto sales or investment sales? or business sales. It depends upon the volume. So if you're selling crypto or investments, you can sell and take the gain up to the capital gains tax allowance. And again, I'm using round figures for this verbal presentation of around just over £12,000. So you can realise 12,000 a year capital gains from crypto or investment sales or share sales without having a UK capital gains tax liability. Okay, so if that makes sense. So every year you can do that. That gives you an option to progress and develop that opportunity to draw down the income. But if you've got 100,000 or 200,000 or 500,000 or 1 million or 5 million or 100 million that you want to realise in a gain, then the timing and the management and the opportunity to go expat for a period to save that 20% capital gains tax becomes well worthwhile. But the timing of the decision needs to be taken to go expat, and then there needs to be a commitment with capital gains avoidance of at least 5 full tax years. There's a grey area with pensions about whether it's 3 years or 5 years, because pensions come under income tax. But again, that's a slightly different area to consider. But essentially, for business, investment share sales or crypto sales or any other capital asset, if you go expat, the timing is to go expat, get your tax residency visa, and your tax residence registered as a non-resident abroad from the UK before you start claiming that expat. Before you start making that capital gains disposal and negotiation and agreement, and then you have to stay out up to 5 years to get that relief. Have in mind that when you choose a jurisdiction like Cyprus, there's 0 capital gains on investments, on crypto, 0 capital gains on business share sales, and as well as the investments. And so you can establish a tax residency in Cyprus connected to the EU and operate there in a low tax environment with no dividend tax, no interest tax, and no capital gains tax on your business and dividend income for the whole of the 5 years that you're living and working abroad. There are other advantages to jurisdictions like Cyprus and other jurisdictions, but to get more guidance on timing, dividend payments, interest payments, or capital gains, and making the arrangements for that, or for income timing, going out or coming back from your country of tax residence, all those services are covered in the product retained client service, which is an online advice and guidance to get answers to those questions. It's an art, it's not a science. We can give you the best advice, and if you need a deep dive and a report or consultant reviews, we can do that as well. It's all available. You can contact us through our live chat at productpartnership.com, or you can register on the retained client service, have free reviews with consultants, and get the guidance that you need to make sure that your timing of dividends, interest payments, and the arrangements for those and the agreements for those, or administering your personal service company or your business administration and realizing your gains, all that services and advice is available through Product Partnership, through the Product Retained Client Service. Thanks for listening. Join us next week where we're talking on a similar topic, but next time we're looking also at using the split year, which has additional opportunities, but additional risks. Thanks very much for joining us, and we'll see you again next time.